Hello everyone, welcome back to Wealth Jalan, your channel for decoding global markets from a Malaysian perspective. Today, we are diving into a very important topic. Will the Federal Reserve's rate cuts trigger the next bull market in Asia? And what does this mean for us in Malaysia? This is a question on the minds of many investors. For almost 2 years, the Federal Reserve has kept interest rates high, attempting to combat inflation. However, recently, the Fed has signaled a pivot toward rate cuts to support growth. This move has made Wall Street broadly optimistic. Lower rates usually mean more liquidity, stronger corporate earnings, and a higher risk appetite. So, the real question is, what will this mean for us here in Malaysia? Today, we will break down the logic behind this and analyze the potential impacts on our economy in the coming months. But before diving into the specifics of the Malaysian economy, it's essential to understand why these global economic shifts matter. The US Federal Reserve has such an outsized impact on the global economy because of the US dollar's role as the world's primary reserve currency. Whether it's commodities, international trade, or even cross-border investments, the movements of the US dollar ripple across all markets, including emerging markets like Malaysia. Part 1. The US dollar and the ringgit, why it matters. Let's first discuss the role of the US dollar in the global economy. As we know, the US dollar is not only the currency of the United States, it is essentially the base currency for global trade, finance, and investment. The strength or weakness of the dollar is driven by 3 main factors. 1. Monetary policy, whether the Fed is cutting rates, holding them low, or signaling easing. 2. Global economic environment, global growth, inflation, and market risk appetite. 3. Geopolitical factors, how political risks and uncertainties affect investor sentiment towards US dollar assets. The US dollar's influence is far-reaching. It acts as the cornerstone of international trade, with commodities like oil, gold, and even agricultural products being priced in dollars. This means any movement in the dollar affects the pricing of these goods in other currencies, which has a direct impact on the cost of imports and exports for countries like Malaysia. So, when the dollar weakens, 2 common scenarios emerge. 1. The Fed enters an easing cycle. This narrows the interest rate advantage of the dollar, leading to its depreciation. 2. Global risk appetite increases. Economic recovery or improved market sentiment leads capital to flow out of the dollar into emerging markets. In this case, emerging markets, including Malaysia, naturally become destinations for these funds. So, what does this mean for Malaysia? First and foremost, we can expect the Malaysian Ringgit, MYR, to appreciate as the dollar weakens. This is driven by 2 main reasons. 1. Global capital inflows. Investors seek higher returns, and Malaysia, with its relatively stable economic environment and policies, becomes an attractive market. 2. Impact on exports and imports. For trade-dependent economies like Malaysia, currency appreciation can lower the cost of imports, while potentially making exports less competitive. However, this isn't a straightforward situation. Part 2. How a weaker dollar strengthens the ringgit. Now, let's explore how a weaker US dollar leads to a stronger ringgit, and what this means for Malaysia's economy. 1. Lower import costs. Malaysia heavily relies on imports, especially for fuel, food, and technology products. When the ringgit strengthens, imports become cheaper. This reduces the cost of living for consumers, particularly for essential items like fuel and food. For instance, Malaysia imports almost all its fuel and crude oil needs. When the ringgit appreciates against the US dollar, the cost of importing fuel decreases. This lowers fuel prices domestically, which in turn affects transportation costs, logistics, and even the prices of goods we buy at the supermarket. Lower fuel costs translate to a decrease in overall inflation, and this gives consumers more disposable income. 2. Enhanced consumer confidence. As the cost of living decreases, disposable income increases. This is likely to lead to higher consumer spending, which will benefit industries like retail, FB, and tourism. In other words, a stronger ringgit could give Malaysian households more financial freedom, which in turn can boost domestic demand and spur economic growth. Take the retail sector, for example. A stronger ringgit means that the cost of imported goods such as electronics, clothing, and even food items may drop. This makes consumers more willing to spend, particularly on discretionary items. This spending behavior benefits businesses across the retail and hospitality sectors. 3. Balancing export competitiveness. While a stronger ringgit may put pressure on pricing for exports, particularly for low-value-added products, Malaysia's high-tech manufacturing and semiconductor industries remain competitive. For instance, if global demand for electronics increases, Malaysian companies in high-end manufacturing can still benefit despite the currency strength. Additionally, lower import costs can help offset some of the pricing pressures. Part 3. The flow of capital and why it matters to Malaysia. Now, let's take a look at capital flows. Global capital flows are driven by two main factors: returns and risk appetite. 1. Returns. Investors are always looking for higher returns. As the Fed enters a rate-cutting cycle, capital is likely to flow into markets that offer higher returns. For emerging markets, Malaysia stands out due to its stable economic foundation, strong industrial base, and relatively low political risk. Take, for example, the technology and energy sectors in Malaysia. As interest rates drop, investors who may have previously shied away from emerging markets will be more inclined to invest in Malaysian assets, both in equities and fixed income. Lower US rates make other markets more attractive, particularly those offering higher yields. 2. Risk appetite. When global economic risks decrease, investors are more willing to invest in markets that offer higher returns. This means that, in such a scenario, emerging markets like Malaysia become even more attractive for foreign capital. This capital inflow could come in various forms. 1. Financial markets. Whether it's the stock market or bond market, capital inflows will likely push asset prices higher, especially in Malaysia's tech, infrastructure, and banking sectors. For instance, sectors like real estate and banking are highly sensitive to interest rates. If the Fed cuts rates aggressively, Malaysian property developers may see an increase in both domestic and foreign demand for real estate. Banks, on the other hand, will benefit from an uptick in loan demand, especially in housing and mortgages. 2. Foreign direct investment, FDI. As global economic conditions improve, more foreign capital will flow into Malaysia, particularly in manufacturing, services, and supply chain integration. This investment will boost local technology, create jobs, and stimulate long-term economic growth. For example, the manufacturing sector in Malaysia, particularly in electronics and automotive parts, stands to benefit from FDI. Companies looking to diversify their supply chains may choose Malaysia as a base for manufacturing due to its relatively low cost and strategic location within Asia. 3. Infrastructure upgrades. With capital inflows, Malaysia will also have opportunities to invest in green energy, digitalization, automation, and data infrastructure. These investments will not only enhance Malaysia's long-term growth prospects, but will also improve its global competitiveness. In addition, a stronger ringgit also means cheaper capital costs for businesses looking to expand their operations or upgrade their technology. Investments in digital infrastructure, green energy, and high-tech sectors will help Malaysia improve its competitiveness in global markets.
本音频由魔音工
Part 4. Which sectors will benefit the most? So, which sectors are most likely to benefit from this wave of capital inflow? Let's take a look. 1. Export-oriented companies, for example, the semiconductor industry. Malaysia is a key node in the global semiconductor supply chain. If global demand for electronics increases, orders and utilization rates for Malaysian companies will rise, potentially offsetting some of the currency pressures. Similarly, the palm oil industry could benefit from a weaker dollar, especially with growing demand for renewable fuels and sustainable feedstocks. 2. Real estate and banking. Lower global and local interest rates typically boost the real estate market by reducing development and mortgage costs. This can stimulate demand for residential properties, particularly in prime locations. For banks, a lower rate environment will likely lead to higher loan demand, whether for personal loans, mortgages, or SME financing. Moreover, more cross-border flows will increase income from foreign exchange, investment banking, and custody services. Take the example of Malaysia's real estate market. Developers and property investors may see higher demand as mortgage rates drop, increasing afford for potential homebuyers. In parallel, banks will likely see an uptick in loan origination, both for consumer loans and mortgages. 3. Consumer-related sectors. As consumers' disposable income rises due to lower import costs, we are likely to see an increase in spending in sectors like retail, food services, and leisure. With a stronger ringgit, outbound tourism costs will decrease, while inbound tourism may increase, benefiting the travel and hospitality industries. The automotive and durable goods industries will also benefit from lower financing costs and improved supply chains. For instance, tourism will likely see a significant boost. As the ringgit strengthens, Malaysians will find travel abroad more affordable, which will likely increase outbound tourism. In parallel, Malaysia could see an uptick in inbound tourism, as the ringgit's strength makes it an attractive destination for travelers looking for good value. Overall impact of the Federal Reserve's rate cuts on Malaysia can be summarized as follows. Capital inflows. Lower US yields may drive funds out of the US and into emerging markets, including Malaysia, in search of higher returns, bringing short-term inflows. This is particularly beneficial for Malaysia's domestic price stability of US dollar-denominated commodities. Improved export competitiveness. A weaker US dollar reduces US import costs and may boost demand, which benefits Malaysia's exports to the US. Easier credit conditions. With lower international financing costs, Malaysian corporations and the government can borrow more cheaply abroad. Domestic interest rates may remain relatively stable, supporting demand for real estate and consumer loans. As US rates decline and global yields fall, Malaysian government bonds may attract more funds and financing costs could drop. If US consumption and investment rebound due to rate cuts, Malaysia's export sectors, such as electronics, palm oil, and petrochemicals, stand to benefit. Conclusion. Wrapping it up. In conclusion, the Fed's rate cuts could bring a variety of positive tailwinds for Malaysia, including a stronger ringgit, lower import costs, and increased foreign capital inflows. While there may be some challenges in the short term, the long-term outlook for Malaysia remains strong, particularly in sectors like technology, manufacturing, and consumer services. However, as I mentioned earlier, the investment environment is volatile, so it's important to stay alert to key market signals and adjust our strategies accordingly. Thank you all so much for tuning in today. If you have any questions or thoughts, please leave them in the comments section below. Don't forget to like, bookmark, and subscribe to this channel to continue bringing you more financial investment information.